Investment advisor, mutual fund representative, portfolio manager. Why does it have to be so confusing? I'm Mark Sabrin from Winnipeg Financial Planning, and this week we break down the differences between each. Let's get into it. In the world of financial advising, it's the Wild West when it comes to job titles. You'll see things like president, wealth manager, financial advisor, life coach, and so many more. Hopefully, this will change one day and we'll see uniformity across the board. But for now, the best way to determine an advisor's capabilities is via their licensing. The three that we'll be covering today are the investment advisor, the portfolio manager, and the mutual fund representative, which we'll start with first. A mutual fund representative is someone who is licensed to advise or sell mutual fund products. This means they aren't able to provide any advice on investments such as stocks, bonds, and others. Now, to become licensed as a mutual fund representative, you need to take one of two courses, the Canadian Securities course or the Investment Funds in Canada course. Yes, that's right. No college or university degree required, just one course, and you can start selling mutual funds. So if you're looking at your statements and all you see is mutual funds, there's a good chance that your advisor is a mutual fund representative. The second type of licensing we'll be covering is for investment advisors. Now, to become an investment advisor, you need to take three courses, the Canadian Securities course, the Conduct and Practices Handbook, as well as Wealth Management Essentials. By completing these courses, an investment advisor can sell and provide advice on investments such as stocks, bonds, ETFs, in addition to mutual funds. So if you're working with an investment advisor, you can have a multitude of different investments. However, an investment advisor is not able to transact on your account, so buy or sell, without your verbal consent. Lastly, we have portfolio managers. And in my opinion, there are two major factors that allow portfolio managers to stand out. The first is the ability to discretionarily manage a portfolio. So this means you can buy and sell within an account without a client's verbal consent. So why is this a benefit? It eliminates one of the conflicts of interest faced by investment advisors. So as I was previously mentioning, if an investment advisor wants to buy or sell a security within a portfolio, they require verbal consent from their clients. So this creates a conflict of interest because if an investment advisor has 200 clients, which one are they going to call first? And by the time they get to the last client, is that trade still as favorable? Whereas a portfolio manager has the ability to make that same trade for every client at the same price. So what other conflicts do advisors face? Subscribe to our channel because in our next video, I'll be going over the different conflicts of interest that you need to be aware of as a consumer if you're working with an investment advisor. To give a portfolio manager discretion over an account, an investment policy statement or IPS needs to be completed. An IPS outlines how the portfolio will be managed. So if someone's a conservative investor, the portfolio manager can't start speculating in penny stocks. So the IPS is there to protect the consumer because the portfolio manager has to respect the guidelines within it. The second reason portfolio managers stand out is they have a fiduciary duty to act in their client's best interest. I know, right? You would think everyone in the financial industry would have a fiduciary duty, but unfortunately, that's not the case. Here's a quick example as to why this is so important. Let's say that you're looking for a dividend investment and you're working with a mutual fund representative. Now, that representative can only sell mutual funds. So if there's another dividend investment, such as an ETF that has performed better or has lower fees, they don't actually have a fiduciary responsibility to make you aware of it. To become a portfolio manager, you either need your CFA, Chartered Financial Analyst designation, or the CIM, Chartered Investment Manager designation, as well as the same courses as an investment advisor. Additionally, an experience criteria also needs to be met. I hope this video was able to shed some light on the financial advising industry. As always, if you liked the video, please subscribe. It helps us out tremendously.